And you're live, Simon.
Hello, everybody. Simon Dixon here, and welcome to another episode. So we're going live today on the topic of altcoins, shitcoins, and Bitcoin. The reason for this one is I get so many tweets and comments and all sorts of stuff talking about, what do you think of this coin? What do you think of that coin? And my answer is always that we've kind of seen it all before. So what I wanted to do in this video, just before we get started, and I'd like to go through a bit of history so that everybody can get themselves up to date. I know that some people would have been through this whole process of seeing all these Bitcoin killers and altcoins and shitcoins and scam coins and all sorts of stuff. And everybody uses slightly different terminology to refer to similar things. But what I want to try and do is give you a bit of the history so that you can see it from the perspective of somebody that was around when there was only one cryptocurrency, and that was Bitcoin, and the different ebbs and flows and cycles. So that's what we're going to be covering today. As always, Azad will be moderating today, so let me know what questions you got. I can see them all coming in right now, probably. What do you think of this coin? What do you think of that coin? What do you think of this coin? And they're probably all coming in. So I guess this is the opportunity in the live chat for people to shield their bags, as the phrase goes. But let us know what questions you've got so that we can actually pick those out, because the first half we cover the content and the second half we jump in to answer as many questions as we can. So a little bit of housekeeping before we get into the content. Thanks everybody for all your amazing comments and amazing feedback on the 4-part video series on retirementplanb.com. It's really great to see that people are finding this content so valuable. We've been working so hard to bring it to you completely free. The first video was talking about 5,000 years of monetary history and making the case for why we are in the Great Depression of the 2020s, to save you the last 20 years that I spent obsessing over this subject. The second free video is on the lessons and mistakes of the most high-profile investors and Bitcoin figures, so that you can learn how to invest during the Great Depression of the 2020s and what you can learn from them. We covered Warren Buffett, we covered Paul Tudor Jones, we covered Ray Dalio, we covered Robert Kiyosaki, Tone Vays, Roger Ver, and who else am I missing? Paul Tudor Jones. Well, you can check out video 2 to see exactly what that was. And of course, video 3 is where we go through how to build a traditional portfolio for the Great Depression of the 2020s with a retirement plan B using 5 Bitcoin investing strategies, and how to protect for inflation, deflation, growth, and decline using traditional markets and how it all fits together. Video 4 is where we summarize this whole thing for those that missed it all, and go through how you can join me to invest $1 million of my personal savings during the Great Depression of the 2020s, and how I would do it if I had no savings and was starting again today. So really, really glad that everybody's enjoying it. We had hundreds and hundreds of comments, so much appreciated. And if you haven't checked it out yet, we release video 4 tomorrow, which is the grand finale. So make sure you catch up on video 1, 2, and 3, because the feedback's just been so great. Okay, so let's jump in straight into the topic. Please do like, please do share, please remember to subscribe. If you hit the like button, that helps us get more content out to more people, and encourages us to give more free content just like this to help many people as possible. So if you could take that time out, hit that like button now if you know you're going to like this. If you're new to the channel, then feel free to wait and see if you like it. But today we're going to be covering the past, the present, the future, and I'm going to end, as always, with something useful for where I think this is going, what direction we go next, so that you can start to think about how you position yourself in these times in the cryptocurrency markets. So bringing it right back to the beginning, when I first spoke at that first Bitcoin conference, there was only one coin, and it was Bitcoin, and it came from an anonymous group of people or person that wrote a white paper on peer-to-peer electronic cash. And the first version of the code was released. The white paper was released in Halloween, October the 31st, 2008. And then in 2009, the first bit of code was released. And we had the Genesis block where the whole Satoshi Nakamoto put into the Genesis block the first Bitcoin that was ever mined in the block, saying banks on the brink of financial disaster. It's late here. Chancellor on the brink of second bailout, referring to the fact that we were in the financial crisis. It was 2008, 2009, and quantitative easing was the bailout mechanism, and that was put into the Bitcoin blockchain. After a little bit of experimentations with that, we got the Bitcoin killers, the birth of the Bitcoin killers. And it was the people that would take the code of Bitcoin, because it's open source, replicate it and say, I can do the same, but I can do it faster. I can do the same, I can do it cheaper. I can do the same, I can do it more secure. I can do the same, but I can do it with better governance. I can do the same, I can do it with privacy. And every single year you get these new coins that come along and say they can do the same, they can do it better, they can do it bigger, better, faster, cheaper, better. Each year, every year, pretty much, you get a different set of coins that are going to kill Bitcoin in the top 20 coins. And they're never really the same next year because a new set of coin comes along when all the others die and say they're going to do it bigger, better, faster, cheaper, better governance, better privacy, and all these things. And so the original ones that we used to have were things like Prime Coin, and Litecoin was the only one that actually survived. But there was a bunch of coins that came along before Litecoin, all saying that they could do it and just tweaking a little bit. A different type of algorithm, a different type of monetary policy, a different type of how many blocks are mined, and different things. But you always get these same iterations, and they always come out saying how they can do things better, bigger, better than Bitcoin. And so really this was the birth of it. And many Bitcoiners, including myself, would always look at these different types of things and believe, because Bitcoin was very unlikely to succeed in itself. But people would always, in the vast majority, look at it as a way of trying to accumulate more Bitcoin by speculating on something that goes through these different cycles. So we had a few years of that, and then we had the concept of the colored coin. And the colored coin got a lot of attention at the time. The colored coin was a way of taking Bitcoin and actually attaching something to it where you could launch another token, but instead of saying, I'm going to do it bigger, better, faster than Bitcoin, you actually just launch the coin on the Bitcoin blockchain. And the Bitcoin blockchain was launched with what we call proof of work. And proof of work is the mechanism that makes Bitcoin secure and very, very hard to replicate, because nobody and nothing has achieved the same level of proof of work as Bitcoin yet. And proof of work is the process of miners, which are these computers all around the world, just burning electricity by running and solving mathematical problems on automation, and getting rewarded with newly created Bitcoins in what's known as the block reward. It happens every 10 minutes, and approximately every 10 minutes, some miners will receive new Bitcoins, and that was the proof of work mechanism. And it adjusts according to how many people are mining. So if loads of people stop mining, then it becomes easier to mine for these Bitcoins. If more and more people are mining, then it becomes more difficult to mine for these Bitcoins. And then they're pooled together in these mining pools. But anyway, proof of work became the mechanism for securing it. And when you're running this proof of work, essentially these computers are performing the role of auditor of all transactions. And all of the different computers that are mining, they agree on one truth, which is known as the Bitcoin blockchain. And the more people mining, the more secure it is, and you have this adjustment mechanism. So people decided that there's no point in trying to replicate that because it was really hard, and nobody could get that mining power. They couldn't get that level of security. So out came the colored coin, and the colored coin was create a new coin but build it on top of Bitcoin and the Bitcoin blockchain. There were several iterations of trying to allow for it. The first one was a token called, or a protocol called Mastercoin. Mastercoin was rebranded to what's now known as Omni. And Mastercoin was where they launched a token built on top of the Bitcoin blockchain. People could buy it with their Bitcoin, and people started speculating on it. And this protocol could be used to launch as many tokens on top of Bitcoin as you could. There was a few developers that were looking to actually push this concept forward. Some of them are Charles Hodgkinson, Vitalik Buterin, and others that were involved in trying to make it where you could create tokens on top of Bitcoin and you could perform and increase the function. Because all the craze at the time was, how can you do stock markets built upon Bitcoin? And how can you have all these different things that were tokens built upon Bitcoin? And then eventually they realized that it was pretty hard to do it. It wasn't optimized for that use case. And then came Ethereum. And Ethereum was a white paper that was created by a bunch of people, this time not anonymous. It was written by Vitalik Buterin and various other co-founders of the Ethereum Foundation. And they tried to build what's called a proof of stake blockchain. And proof of stake means that rather than burning electricity, those that hold the coins actually get a vote in the future of it. And the proof of stake is essentially secured by the people that actually stake their tokens. But Ethereum couldn't figure out how to do it on time. So instead, they launched a proof of work, similar to Bitcoin, where you could burn electricity. And within the first year, they said that they would convert it to proof of stake. That's actually happening probably, well, as we speak in beta, but certainly towards the end of this year, early next year. So it took them approximately 6 or 7 years longer than they thought, or 5 years or something. Can't remember the exact years for this. But Ethereum was launched as a proof of work with the intention of going proof of stake and proving that there might be another model that you can use to secure a cryptocurrency and a blockchain. They never quite got around to it, but they're getting around to it now. So from Ethereum came this the ability to create all these tokens. And so you had lots and lots of different use cases being built on top of it. And there was a real appetite as more and more people started creating these tokens because Ethereum was more optimized for that use case. And this whole craze came along called the flippening. And the flippening was that Bitcoin has never, we had this website, CoinMarketCap, that popped up, and it used to rank all these different cryptocurrencies. And every year the top 10 would change, but Bitcoin would always remain number one and has never been taken off that spot. Well, Ethereum started to get traction, and this whole thing called the flippening came along, where everyone was forecasting that the market cap, i.e. the price of the coin times the number of coins, because Ethereum's producing got a much bigger supply and it was getting traction, that the market capitalization would be worth more than Bitcoin and it would flip over. And so that was the projection. And as more and more tokens were being created on Ethereum, and more people were forecasting the flippening, where Ethereum take over, but it never quite flipped. So guess what comes next? The Ethereum killer. So then everyone comes along as more and more people, as Ethereum starts to get more and more traction, and it starts to hit some scaling issues. Everyone comes along and say, I can do Ethereum cheaper, better, faster, more secure, more private, more governance, better this, better that. And then you get the rise of the Ethereum killer. But nothing really quite killed Ethereum. Ethereum started to still get more and more traction. But everyone started to come along saying, put all your money into it, put your ETH into this. We're going to kill Ethereum. And what they used to do is they used to come up with a new concept. They'd launch a token on Ethereum. They'd use that money in order to build an alternative blockchain. And then they'd try and swap out those Ethereum tokens for tokens built on their own network. And then you get all of these Ethereum killers. And you get copycats, you get hard forks, you get plagiarized version. And you end up with all these people saying, we can do everything better. Then what happened was a bit of a craze as all this technology started being built on top of Ethereum. everyone started to try and get rid of the word Bitcoin, and the corporates tried to take over. And really, you started to have the bank coin. And the bank coin was where they tried to say and popularize that Bitcoin's not needed, blockchain is the innovation. And so we went through this phase in approximately 2014, where everyone was really about how you can build banking technology on a blockchain. And Bitcoin became a swear word, but banks went around the world and popularized the word blockchain. Now, nothing that they were building on top of a blockchain worked, and so everyone ended up going back to Bitcoin eventually. But Bitcoin became this thing that the banks tried to get rid of and really tried to take on the blockchain. Round about this time, I remember the early days, some of the early Bitcoin developers like Mike Hearn tried to turn Bitcoin into Bankcoin. The goal was, I remember a proposal that he presented to us at a presentation, was how you can put passports on the Bitcoin blockchain so that the know your customer KYC data could be transported and the identity could be connected. And really, this is where you started to see these different iterations of Bitcoin. Couldn't get that past the consensus mechanism, couldn't get it into Bitcoin, and ended up doing about it a rage quit and a hissy fit saying Bitcoin's dead, it's not going to go anywhere. Then there was also the Ripple as well. Ripple was created by the founder of Mt. Gox. Mt. Gox was an exchange that was very controversial. It was the first exchange that gave a price. And the creator, Jeb McCaleb, decided that wanted to create a protocol using the Bitcoin blockchain technology that would actually allow to work with the banks in a more collaborative way. And so Ripple was launched. It was originally some technology that would allow to try and compete with Swift. Full disclosure, the company, Ripple Labs, I am a shareholder of through Bank to the Future. It's now worth approximately $10 billion as a company. But Jeb McCaleb was sold the Mt. Gox exchange, and the story goes that it was missing 80,000 Bitcoin when he sold it to Mark Capellas. And Mark Capellas is the guy that's going down for allegedly creating the Ponzi scheme. But he actually bought an exchange that had 80,000 Bitcoin missing. And now he bought that from Jeb McCaleb, who was the founder of Ripple. And then Ripple took that technology and then launched a token called XRP. And everyone got confused between what's the token, what's the company. But XRP is now the third largest cryptocurrency, built upon the premise that you could use a token to convert in and out through this technology to provide liquidity in order to create faster ways of banks transferring money to us. So this was the final, I think, where we are iteration of XRP. There was create our own blockchain. There was try and get Bitcoin to become Bankcoin. And then there was Ripple that created the XRP. And then you later, where we are today, you have, for the very first to do it was China Coin. I released a video in 2016 talking about China's central bank digital currency. And then you had the Fed coin, where Fed were talking about launching their own coin. And finally, the iteration that actually started to get traction was the concept of the stable coin. So now we've got Bitcoin and we've got all these different coins that say they can do cheaper, faster, better, never quite achieved it. You had Ethereum that came along and said, well, we'll do something different. We'll create this protocol where people can program financial products on top of it. Started to get traction. So now you got number one, number two today. And then you have Bankcoin, where XRP started to take that spot. Moving a bit further down the chain, you had stablecoins. Stablecoin was an innovation from a company that I am a shareholder of, Bitfinex, which is a cryptocurrency exchange, one of the early ones. The way that it actually, the idea was that a lot of the exchanges really had trouble, and still to this day have trouble, securing banking services. Now, the industry has moved on a lot. I'm a shareholder in many different exchanges, so I try and disclose where I can when I talk about something, so you can decide whether to discount it as me pushing self-interest or whether you actually want to listen to it. But the stablecoin took ages to get any kind of attraction, use case, or connection. So the first one was a company called Tether. And Tether, well, the first one that got traction, there was a few iterations. It was actually bought by Bitfinex from an entrepreneur called Brock Pierce, who tried to create a token. If I can't even remember the name, I think it was True Token, Trust Token. Can't remember the name. Sorry, the history is getting back to me. But the stable Tether came along, and it was pitched to all of the exchanges. So different exchanges that I'm a shareholder in, Coinbase, Kraken, various other ones. The stablecoin was a concept of how can we move money between our exchanges so that speculators could arbitrage faster, because getting money from one exchange to another via bank wire was a really, really painful, slow, problematic process. So what if you could take this technology, and remember I talked about the early, before Ethereum, was Omni, and Omni was a protocol that was built upon Bitcoin, and Tether was originally built upon the Omni protocol. So it was all on Bitcoin, where you could actually peg its value to the dollar. So every time someone put $1 in a bank account, one Tether would be issued. And you would have this supply of Tether that's backed by dollars in a bank account. And so Tether was created. And for years and years, approximately, you could only get it was about $5 million market cap for a long time. Suddenly, different crypto to crypto exchanges, one of those was Poloniex, was the early ones, where they didn't even have a bank account. They were just allowing people to trade between cryptocurrency to cryptocurrency. But then the secret sauce that made it work was when Tether, the stable coin, started acting as a mechanism for exchanging. Prior to that, Bitcoin was always exchanged into shitcoins and altcoins and various other scam coins and all sorts of stuff. But then Tether started to become very, very useful for this. Bitfinex and Tether, the company, had the bank account, and more other exchanges could build on top of Tether and really have a price where people could see that it was pegged to the dollar. So people could see and understand the price, because people understand fiat currencies easier in terms of thinking in prices, unit of account. But then different exchanges came along. So one of them was Binance. And suddenly Binance didn't have a bank account, but it grew really, really fast, right place, right time, because of Tether. Because Tether provided the bank account so that Binance didn't have to deal with banking, which allowed it to scale. And suddenly, in a very fast period of time, about 700 million of Tether was in the bank account of Tether. That was all happening through Binance. And Tether became like the bank account to all these different crypto exchanges. The industry started to grow. It started to go through billions, and then the market cap started to grow. And really all of these exchanges started to grow, and Tether became this way of actually transferring value backed by the dollar using all the power of the Bitcoin blockchain. As it started to scale more, it took some of its Tether and put it on Ethereum, and now Ethereum is the vast majority of all the volume for Tether. Tether was created, Tether was the innovator, and then other companies, I'm a shareholder in a company called Circle, and Circle started to take the US regulatory structure and create a more regulated version of Tether in compliance with US laws. And so they started to learn from some of the things that might have gone wrong with Tether and create a different version. And then you had the USDC stablecoin. At Bank to the Future, we have a secondary market where you can buy shares in Circle, which is the issuer of the USDC stablecoin, or Bitfinex, which is the partner company for the Tether stablecoin. And then you started to get more and more innovation as Ethereum started to get smarter and smarter. And people started to realize that you could build these stable coins without actually backing it by dollars, just through algorithms. And so now you have things like, the most popular is DAI, whereas an algorithmic stable coin, which tries to maintain its peg by not being backed by dollars in a bank account, but backed by algorithms. And so you've got these different stable coins, and then everyone started to jump on the bandwagon. You had the Gemini stable coin, the Binance stable coin, Paxos, and all sorts of stuff. And so this is the origin of the stablecoin, which actually now has become a really good way of onboarding into the crypto industry. Prior to that, you had the platform token. You had basically tokens that were connected to a particular use case of a company. Some of the early ones were companies that I also invested in, that we raised funding through Bank to the Future. Companies like Storage that wanted to take the concept of, could you do what Bitcoin did, where you reward people for auditing all the transactions? What if you could reward people for sharing some of their computer hard drive space and create this decentralized network of cloud storage? And then you had different things like the Bank to the Future token, which is a rewards token for those that invest more through Bank to the Future. Companies that we're shareholders in, like Celsius, who provided lending service, they created the Cell token as a mechanism. And the really popular one was Binance, that created the Binance token, whereby you had these different mechanisms for rewarding people connected to an individual platform. As the platform got more traction, you started to increase the demand for these different tokens. Now, in 2017, it went through an absolute craze where everyone was creating all these tokens. And we went through the ICO boom and the ICO craze market. Just before we go that, if you're enjoying this content, please do hit the like button. If you're not a subscriber, hit the subscribe button, hit the bell symbol. If you click all, then YouTube will make sure that you're always notified every time we go live. So if you could hit that like button, I'm going to take a quick water break and we'll get back on Beyond the Platform token. Okay, hitting the halfway mark. So let's start getting through to the next phase. And this is where we start looking at where we are today and where things go next. So you had all of these people, all of these technology people that were just launching tokens, selling them to investors, and thinking that they weren't investment products and therefore didn't need to comply with any types of regulations. Eventually, regulations caught up with that, and everybody started to recognize that if you're selling investments, actually, there are lots of laws you need to comply with. And we ended up where people started to innovate, where how could you take those regulations and put them actually into the cryptocurrency and the token? And we had the security token. Back in the day, we had these things called Bitcoin IPOs. Bitcoin people were actually calling them Bitcoin IPOs. They were trying to go public on the Bitcoin blockchain and sell it for Bitcoin. Then obviously you had Omni and various other things. Ethereum was what really made the ICO craze, which instead of an initial public offering, it's called an initial coin offering. And as that started to hit a crackdown, the exchanges started to act like they could sell investments. And many of the cryptocurrency exchanges do what they called IEOs, which was initial exchange offerings. Which is selling investments and allocating it via the exchange rather than doing it themselves. And so now you end up with this crazy cycles that come through. You know, you get to people doing ICOs saying, I'm going to create a bigger, better, faster Bitcoin every year. The top 10 tend to change, and you get all these crazes and people running around like headless chickens trying to find the next thing, the next big shiny object. In the meantime, the tax laws and tax regulations start to catch up and start to define this asset class. And every time people are trading between all these different tokens, they create a tax liability for themselves, bringing us to where our industry is today, where people are trying to figure out what to do with this. So tokens are now becoming security tokens. And exchanges around the world are applying for securities licenses, and they're looking to do disruption in the traditional financial markets using this, but this time complying with different securities laws. You have tokens that were being revenue shares, paying out dividends, token buybacks, and all sorts of mechanisms. And everyone gets more and more confused. You have these 10,000 different cryptocurrencies and tokens and iterations and Bitcoin killers and all sorts of stuff. And that brings us to where we are, where everyone's always pushing their particular token. And the same story comes around year after year. We've got this new blockchain that's going to kill Bitcoin. We've got this new smart contract platform that's going to kill Ethereum. And we've got this new innovative way of doing all these different things. The latest one is the DeFi coin. So the DeFi coin is where you build up all these different financial products, and you build it into the protocol. You build them. Most people are building them on top of Ethereum. But then in order to actually capitalize on that, they launch their own token where you have to have that token in order to access that. And you end up with decentralized insurance, decentralized stable coins, decentralized governance structures. And every few months you get these, every week, in fact, you get these different coins that are coming as a result of that, and all these decentralized exchanges. You get some genuine innovation out there. So eventually this all merges into some kind of innovation. But you also have the scam coin. And so everyone has a different definition of a scam coin. If you watched video 2 on retirementplanb.com, when I talked about the lessons and mistakes of different investors, I talk about how to actually navigate that and not get distracted with all these different things. But some people, the Bitcoin maximalists, say everything apart from Bitcoin is a scam. Others define a scam coin as something that genuinely is created with the intent and purpose of actually defrauding investors. So examples of those is OneCoin, Plus Token, BitConnect. They're all the ones, it reaches a stage where everyone was telling me how, everyone that knew nothing about this industry started telling me how OneCoin was going to, and they're always built upon killing Bitcoin and taking advantage of people's, lack of knowledge and uncertainty around such a complex subject like financial technology. And so you get these signs. So recently, about $4 billion was seized by the Chinese authorities from the Plus Token Ponzi scheme. OneCoin is a Ponzi scheme that people that were still shilling this MLM thing, they actually are still pushing for that. And the creator of it has just disappeared. And there's all sorts of things there. And then you have BitConnect, which promises you that they're going to pay you, like 10% per week, 1% per day, whatever, outlandish returns, because it is actually a Ponzi scheme as well. So that brings us to where we actually are today, and what has our industry actually done as it goes through these cycles. And you'll see these cycles go through time and time again, as everyone starts to try and push you into these different tokens so they can make more money. Where we are today. So today, US dollar is still the unit of account. When everybody thinks about the value of these cryptocurrencies, they always think of them in terms of dollars, or they think of them in terms of their own currency. So fiat currency is still predominantly a unit of account in terms of how you think. BTC, Bitcoin, has become a reliable store of value. In the traditional world, it's what I call a speculative store of value, where you can speculate on whether it will become a store of value like gold and get asymmetric returns if it actually does. But in the actual world of cryptocurrency, in times of danger, everyone's looking at Bitcoin as the store of value. There's a bunch of people that will tell you that, no, this isn't Bitcoin. This hard forked version is the real Bitcoin. And whenever you talk about Bitcoin, you'll get some people on Twitter or on the comments that will always say, I know Bitcoin isn't Bitcoin. Bitcoin is this. And they create their own version and they say, this is the real Bitcoin. In terms of financial products and decentralized, it's all happening on Ethereum. And there's a bunch of people that are trying to take some of that market share. Median of exchange is actually stable coins in the crypto market. So in terms of actually, when I went last time before all these lockdowns, when I was in China, you speak to anyone in the crypto and market, especially when we're in a bear market, and Tether was the only way that they would actually accept payments outside of the fiat world. And so really, when you look at where we are, what's the present today? You have the dollar as a unit account. You have Bitcoin as a store of value in the crypto space. You have ETH as a protocol for decentralized financial products. And you have Tether as the medium of exchange, with lots of other things all looking to say, I can create a better stable coin. I can create a better protocol for these different types of decentralized financial products. I can create a new unit of account and I can create a new unit of store of value that's going to kill Bitcoin. And you end up with more and more people trying to do that. So what is the future? Well, the future, as I see it, is that you have regulatory crackdowns in all of these cycles, as we have always seen, and regulations drive us in two different directions. The directions you have is genuine financial innovation that complies with regulations, and therefore you have lots of financial institutions that build lots of products that comply with this, and it makes better financial products as a result of increasing competition. You get better fiat currencies as a result of increasing competition that's driven from these regulations-driven innovation in this industry. But then as regulations gets harsher and harsher and harsher, you drive people to get more and more innovative with more decentralized financial products. And they look at how you can take those regulations and put them into disrupting regulators by just coding it into the protocols itself. And so you get this, this regulatory innovation that drives people to these better regulatory solutions and these better, more decentralized solutions, where eventually you end up with artificial intelligence doing much of what humans are doing now as it starts to reach out to its infinite, all driven by trying to code up regulations and disrupt human interaction in these financial products. Eventually, I think you will get a crackdown on decentralized financial products, and that pushes more and more innovation into deeper and deeper decentralized financial products until eventually you have things that are genuinely decentralized, and then you have regulators that come out and say things like they did with Ethereum, where once it is sufficiently decentralized, we don't consider it something that we need to regulate at the protocol level, and you end up with those two tokens, which authorities all around the world have said is too decentralized to actually regulate at the protocol level, which is Bitcoin and Ethereum as it is today. And then you get lots of different things that are built on top of these different protocols. And then you get a crackdown on the centralized institutions and on the complying with those regulations. And here we go, we wash, rinse, repeat the cycle. And so I hope you enjoyed that as a little guidance on the history, the past, the present, and the future that I see in terms of how you put that into somebody that's new to this industry that may not understand all these different protocols, or somebody that actually just wants to keep things a lot more simple in building their portfolio. And then check out video 3 on the free video on www.retirementplanb.com. And that goes through how you can actually really simplify this based upon somebody that's been there from when there was one coin to today, pardon the pun with one coin, been there when there was just one, which was Bitcoin, and been through all the different scams and everything that came along in between, all the altcoins, all the shitcoins, all the innovation, and all the different regulatory crackdowns. And if you want to keep it simple, then check out that video. So let's turn this over now to the AMA part of this broadcast. So Azad, hopefully you've got questions, and I hope we're not just going to get a million, Simon, what do you think of this coin? What do you think of that coin? And everyone trying to shill their coin in their bags.
I'm afraid we've got loads of those for you, Simon, but I'm going to try my best to, we've actually got some really good questions, but here's what I want to say. Since I've known you, you have been consistently fixated on Bitcoin, whilst everyone else was sort of getting washed away with all these other so-called opportunities. How the hell did things like BitConnect, which is still there, how is it still going? Why are people still attracted to it? So your thoughts on BitConnect and the embarrassing promo video?
Well, BitConnect is now a proven scam, and it's it's authorities, people are being arrested and people are in prison as a result of this. Same with OneCoin, and same with some of these other actual fraudulent scams. So I guess we have to come up with the definition of a scam. Some people say anything that's not Bitcoin is a scam. It's not my definition. Others say anything with the purpose of committing fraud might be a scam. And then you have different iterations in between, and you never really, scam becomes this word that everyone uses to describe everything that's not really their position. But the reason that, consistent to Bitcoin is because it was started from a vision that attracted me. So, Bitcoin versus the banks was a very attractive thing in my history of what interested me. Now, if you want to take advantage, and I have taken advantage of opportunities to try and accumulate more Bitcoin, as I described in video 3, then it's okay. But the problem that I've seen is that people do not use sound risk management, money management principles to know when they're dealing with a gamble versus when they're actually investing, versus when they're actually spending money, versus when they're planning for their retirement or actually trying to accumulate that. And this is where it comes to really traditional financial planning, money management, risk management principles, and exercising some of that. And fortunately, because I did come from traditional finance, and because I did come from investment banking, market making, trading, I saw what happens when we as a market maker just would scalp. The 10% of insiders would scalp money off the 90% of amateurs that were always chasing the next big shiny object, looking for the next big tip, looking for, and never really educating themselves, which would really feed the 10% of hedge funds, insiders, and all sorts of stuff at the expense of the 90%. So from that background, I saw that. I also saw my father lose all of his pension in the dot-com boom and bust, where he thought he got good at trading and then overexposed himself, and then ended up leaving the market saying this whole thing is a scam. And so really just based upon life and being involved and coming from these different backgrounds, when I saw the Bitcoin and all of these cycles repeat themselves, I was a market maker on, penny stocks and alternative investment market stocks, and they perform very similar to these different cycles. Obviously, there's a bit more regulations involved in there, and this was a fully, a completely unregulated market at certain stages. And so seeing that, I saw many different parallels and just really developed my own approach that worked, that make sure that we could stay in the game if this industry grew, and really defining that investment thesis. So this is where if you're interested in understanding what actually allows you to stay on the right side of this, it's actually the psychology in the end. And I created a video called Increasing Your Financial IQ, which talks about some of the different factors, 10 different factors that actually makes the difference between you executing, achieving your financial goals, increasing your financial IQ, versus chasing the next big shiny object and making some of the mistakes that I talk about in video 2 on Retirement Plan B.
Simon, what's your experience like when you're dealing with somebody who's quite famous in the crypto market, like Richard Hart, the founder of Hex? What was your experience like in that interview?
So I did an interview. If you look at the financial IQ video, I talked about this concept of always trying to come with an open mind and try on the ideas of people you disagree with. That's something I've always tried to exercise. But Richard is my experience of Richard is that he pushes whatever he's in at that time. So when he was really into Bitcoin, he pushes Bitcoin really well, really hard, and was a really great evangelist for Bitcoin. Then when he decided that he wanted to build something on Ethereum, he pushed Ethereum really hard and completely slammed Bitcoin. And then when he created his own thing on top of Ethereum, then he would slam the how his thing is much, much better. And he's really, really great at creating the case for whatever he's pushing at that time. He's really good at that. That's my perspective of Richard. And he comes up with some unbelievably good content when he pushes what he's trying to push. But then it's always pushing whatever he's pushing at the time and slamming the thing that he's not pushing at the time. So that's that's my experience, and came on his show when he was telling me about his new thing that he's created and why I should be interested in it. So tried to give him the time of day to listen to what that is, but we talked about different topics and different things. And so I was trying to make the case for Bitcoin, and he's in anti-Bitcoin mode at that time. The next Bitcoin killer. There we go. He's giving the Bitcoin killer argument.
What's your thoughts on how the future is going to look with respect to, we've got here in the UK, the Times Rich List. What's it going to look like with cryptocurrency millionaires?
Well, we're already in the cryptocurrency billionaire stage. There are billionaires in the cryptocurrency industry. There are multi-millionaires in the cryptocurrency industry. And I do think that Bitcoin, unfortunately, is not going to fulfill the goal that some people want it to fulfill. I think it will have a big rich-poor divide. And I think that the reason that things have a rich-poor divide is because of psychology. The rich, often get richer because they play the systems. And the systems can sometimes be, but they find how to play within the existing systems. And so I think that Bitcoin doesn't lead to a greater rich-poor divide. It creates a new class of billionaire, eventually probably trillionaire, and multi-millionaire. And you get the same psychology doesn't change there. You get some people that will only buy Bitcoin when it's at the all-time high and will only sell it when it's at the all-time low because of the emotions of fear and greed and FOMO. And human psychology doesn't change. It just gets applied to a new market. And so you get these distributions. And I do believe that Bitcoin will be it's already done that. It took a new class of people, techno geeks originally, and made them multi-millionaires and some of them billionaires. And so you get this wealth redistribution through different asset classes, depending upon when people join and when they decide that it's right for them.
Well, altcoins replace the stock markets as we know it.
Well, this is an interesting question because the original iteration, the ICO boom, was going to completely disrupt stock markets, except for there was one boogie monster, and that was that they were all illegal securities. And so while if it continued on its trend, then everybody would have delisted, the large companies would have delisted from the stock exchanges and said, why do I need to comply with all these regulations when I could just do in this unregulated market that regulators don't seem to be enforcing? And so it would have disrupted the market completely. But then when you introduce the regulations, you start to think, well, what are the true disruptors? What are the forces that it can do better? And one of the things I think security tokens can eventually do better, it's too early at this stage, is I don't think that altcoins disrupt stock markets because equity comes, as many people experience. We have investors on Bank to the Future. It comes with shareholder rights. It comes with dividends. It comes with entitlements. It comes with legal protections. And all of these are very useful things that you don't necessarily want to take out. But one of the things I think security tokens can do is disrupt the need to pick a geography when floating your investment. So right now you need to pick, I want to float on the London Stock Exchange or Tokyo Stock Exchange or Shanghai Stock Exchange. And part of the capital wars that I talked about in the World War III video is because more people are floating on the Shanghai Stock Exchange, losing market cap in the New York Stock Exchange. So you have to pick your geography. I think security tokens can make it where these stocks can actually be interoperable between multiple exchanges. So the exchanges then can compete by making it really interoperable, where the asset can be independent of the exchange, and it makes its way to the correct exchange. So I think that's one thing that can be had, but I still think the security token industry, we started investing in it I invest in a company called Securitize, but I think it's about 3 years ahead of its trend. But I like to pick these things approximately 3 to 4 years before they might actually get the traction where everybody's talking about them and everyone's getting in. Longer term time frame is my particular approach for certain investments in these types of opportunities.
What will happen to altcoins, shitcoins, post hyper Bitcoinization? Sorry, I can't pronounce that. Presumably they will still exist, but who will use them and why?
Yeah, so there's two different types of schools of thoughts that a few schools of thought. So deconstructing that, some people believe that the world will converge on this one cryptocurrency, Bitcoin, and there'll be hyper Bitcoinization, which kills all fiat currencies. I think competition will prevail. I don't think we get hyper Bitcoinization. I think Bitcoin becomes a particular use case, and fiat currencies still fill their certain use cases. And Gresham's law means that people start to change the way that they allocate money, which is the concept of you wanting to spend your money that you think is crap and keep your money that you think is good. And so taking that into the altcoin markets, you start to see that people try and keep their Bitcoin, but then they try and get rid of the money that they think is crap or less of a store of value. And so you get these different cycles. We see that because everything is a Bitcoin-led market in the cryptocurrency market, when Bitcoin goes up, you tend to get alternatives going up faster. So that creates this ability, this more speculation on people trying to accumulate more Bitcoin, coming out of Bitcoin into alternatives. And when Bitcoin crashes, alternatives crash harder as well. But the market tends to be pretty correlated. But then you get these, you just get these rampant speculative opportunities which drives people insane, trying to make thousands of % returns in very and ultra manipulated markets. And so, and then most people try and play those games and they tend to get crucified, create tax liabilities to themselves, and then restart the cycle again when they end up with no Bitcoin. Covered a bit about that in video 2 on the lessons and mistakes. But what I've found anyway, in terms of the market's pretty correlated. Some people believe that, as people try to dump all this stuff and go into Bitcoin, you get this ginormous crash of the alternatives and a pump of Bitcoin. But what we've actually tend to see is that in bull markets, in Bitcoin bull markets, you actually get correlation. And because people tend to put their money into the alternatives to try and beat Bitcoin returns, they sometimes pump harder because you're taking the disproportionate risk. So I think the markets grow together and the market cap goes up and up and up. And you just get these, very short-term cycles, and you get, some come in the top 10, 20, some go in the top 10, 20. But you always get this store of value concept with Bitcoin. And some people we're starting to see as well, the Ethereum first institutional investors coming through now, we're starting to hear about.
Okay, I mean, we've got a question about live AMAs that were meant to happen. So there's a question which I think connects with it, and we can hopefully satisfies those people who wanted to listen to you talk about how many Bitcoins you should own. So you've also mentioned about, I think, a tweet you did in terms of how many Bitcoins are left. So when the 21 million Bitcoins have been mined, what is Simon's view on what happens next with the network?
Okay, yeah. So this is the importance of transaction fees. So miners receive two types of fees. One is called a block reward, which is the way that the money supply of Bitcoin is released into the world. And that is those that are mining receive part of the block rewards, and it goes and it converges until eventually you hit 21 million and no more Bitcoins are created. At that stage, you rely upon transaction fees, which is the second way that miners actually make money. And so miners make money through transaction fees and block rewards. Eventually, the transaction fees goes up because you need to subsidize the miners to secure the network. And so Bitcoin becomes more expensive to transact in as more and more, as the block subsidy, the rewards actually goes down. Or you end up with this network that's doing so many transactions that lots of transaction fees end up becoming the revenue stream for miners. But the block debate, or the scaling debate, was all about keeping fees lower by increasing block sizes. But eventually you need a fee market because eventually by 2140, there'll be no more Bitcoins. And almost all of them will be mined within the next 20 years or so. 18.5 million of them have already been mined. So that's where you switch to a fee market as opposed to just block reward.
Thank you. What do you think about lending platforms like Celsius, BlockFi, etc.? Do you think these companies are too risky, or should I just cold storage my Bitcoin? And your final thoughts after that, Simon?
Yep, that would be my final question. So full disclosure, I am a shareholder in Celsius. We did the funding round at Bank to the Future. And again, this all comes down to risk and money management. Should you take all of your Bitcoin and lend it? Suicidal strategy. People do that, yes, all the time. And that's how you end up with no Bitcoin when things go wrong. Should you take all of it and put it into cold storage? Well, that's the conservative approach, and that's how you can have a hassle-free. But I personally believe in taking a risk-managed percentage of it and trying to accumulate more Bitcoin. So this is where I go through, check out video 3, where I talk about the different Bitcoin investing strategies. And so many people come, what I've found is that people come from different ideologies. So if you've been around Bitcoin for a while, there's a whole mantra that was popularized by Andreas Antonopoulos, who really popularized the phrase "not your keys, not your coins." And by the way, Andreas is going to be covering the whole security part of Retirement Plan B. My go-to technical advisor and expert, and great that he's never associated himself with the course apart from a university course, but he's going to be part of the Retirement Plan B coaching program. So really excited to have Andreas. But he popularized the phrase "not your key, not your coins," which is a great phrase, a great mantra. But it doesn't mean you need to apply it 100%. And this is where a bit of risk and money management comes into play. So I encourage people to define their rules. That's what we work and what I do, and that's what I'll be doing for that. So in terms of concluding thoughts, it's been a interesting week to say the least. People are starting to unwind and start to think about the holidays, depending on where you are in the world. Tomorrow, I will be releasing the final video of the 4-part video series. If you haven't watched that yet, try and catch up with it before tomorrow. You can watch video 1, 2, and 3. All of them are under half an hour each. So, the feedback so far, I think you'll get tremendous value from them. And you can check those out at retirementplanb.com. And those are free and my gift to you. Tomorrow, the final video comes out, and that's where I'll be sharing with people how they can join me to actually build a retirement plan B alongside myself. So always remember, as always, you are alive at one of the most interesting and exciting times in financial history. I'd like you to be on the right side of that. Some people are going to get hurt. Some people are going to do well. And if you enjoy this content, then let me know in the comment section what you'd like to see in future videos. And now it's the end. You can decide. Please hit a like if you enjoyed this. That really helps us. And I'll be releasing more content. So subscribe to my YouTube channel, Simon Dixon, hit the bell symbol, hit all. And next week, I'll be back to cover more of your questions. Over and out. Peace.